Hey guys, how you doing? I'm Kent Tilley with K4 Financial, and today I'm going to talk about something that comes out to certified financial planners once a year, which is the FP financial projection guidelines that we are supposed to use for long-term projections when talking with clients about sort of what we can expect to show as potential returns. Are these going to be accurate? No, they're projections. This could be, high or low. We don't know that. However, this just gives us the guidelines, and this sort of shows an example of why when we are working with clients or doing $500 financial plans, why we show lower potential rates of return than a lot of our competitors do is because we're actually using these guidelines instead of just pretending that you're going to get 7, 8, 9% and hoping for the best. Obviously, we want you to get those rates of return, but if you've noticed anywhere in the last few years, you certainly haven't been, because things always kind of revert back to the norm. So we'll just go through this list. I think their inflation rate is, a little aggressively low. It's been kind of holding steady here for quite a while. It's showing 2.1%. We might use 2.5 just because, okay, depending on the conversation we have with the client, what do you think? Hopefully inflation does get down to, a more normalized level in the relatively near future. And then the return rates. And what you need to understand about the return rates that they're showing is that this is justifying their return rates over 10 years, and this is before fees. So this is big. This is where fees really play a factor in this. So it's got short-term projections of 2.3%. So that's basically like cash or, GICs or something like that, high interest savings accounts. Right now they're a little bit higher than that, but they assume that over 10 years they'll go back to a more normalized level like inflation. Fixed income, this is the fixed income portion of your portfolio, primarily made up of bonds. They're assuming a 3.2% rate of return on those. Again, this is before fees. Canadian equities, they're assuming 6.2%. So they're assuming every company in Canada put together, you're invested in all of them, you should see a 6.2% rate of return if that's all you were invested in, which isn't necessarily a good way to invest. Then it's got foreign developed market equities. That's mostly talking about the US, but also say, China and Europe and places like that. They're actually developed with a 6.5% long-term rate of return. And then lastly, we've got emerging market equities, which is the biggest risk in a portfolio, but these are countries like, say, Brazil or, India or something like that, where now it's projecting a 7.4% long-term rate of return. This is going to be the most volatile of the bunch, which is why it's showing a higher rate of return. And then it's got a YMPE growth rate of 3.1%, which doesn't make a ton of sense to me because generally I think it should kind of go up with inflation, which they're saying is 2.1, but YMPE is, that number that goes up. So you see your RSP contributions increase every year. You see what you're paying into CPP every year. So that's actually going up beyond inflation, which isn't good for small business owners or employees that now are already strapped for cash and they're going to have to pay more into CPP than they're actually earning on inflation, which isn't great. So I don't love that number. And then their borrowing rate of 4.3% on average, which would be a really good rate for a lot of people right now. So they're hoping that it goes back down. Now, not everybody is invested 100% in any one of these things generally. You should have a diverse portfolio. So let's look at kind of a rough average of a 60-40 portfolio, which is just sort of a moderate portfolio where 60% of your of your money is in equities and 40% is in fixed income. And let's look at how that would work out. So you've got 40% in fixed income, earning 3.2%. You've got 25%, say, in Canadian equities, earning 6.2%. You've got 25% in the US and Europe, earning 6.5%. And then you've got, say, 10% in emerging markets, earning 7.4%. You add all of those up, now you have a projected rate of return on your portfolio of 5.2%. But now, let's remember that most people are paying a lot of fees. Most people are paying 2% or above in fees. So what you have to do if you have that portfolio is now assume that your 5.2% rate of return is reduced by your 2% in fees because that's paid out of the gains. Now your projected rate of return, if you're paying 2%, is 3.2%. Is your advisor that is showing you your projected retirement or rates of return showing you a 3.2% long-term projected rate of return? Never. But they're supposed to. They're showing you 7, 8, 9%. I see, let's say WFG all the time showing 7, 8, 9% as long-term projected rates of return, where they're charging 2.5 or 3% in fees. Now they should actually be showing you 2.7% in your long-term projected rate of return, but they're never doing that because they're selling you on returns. It's terrible planning. It's really bad advice. You're probably not going to get it if you're paying that much money, and you're not supposed to show it that way. So why are they doing it, and why are they allowed to get away with it? Drives me crazy. So in the next video, I'm going to talk about how to just increase your odds of investing success. It's very simple. It's very straightforward. So like and follow for the next video. And if you have any questions, please look up us at k4financial.ca. We've got the $500 financial plan. If you want to just look at the investment fees you're paying or your portfolio or whatever, we're happy to do that. We're not always recommending that you pay even anything in fees other than the minimum you might have to pay to go self-directed in an ETF where you can keep your fees as low as possible if you don't have planning needs. And if you don't have planning needs, then you certainly should not be paying 2% or more to some institution and some person that's not actually helping you in any manner. And that's the bottom line.